Most growth investors talk about QQQ. They talk about AI stocks. They talk about big tech. They talk about the same famous tickers over and over again. But there is one growth ETF that many investors overlook: VUG, the Vanguard Growth ETF. It is simple. It is low cost. It gives broad, large-cap growth exposure. And in 2026, it may be worth asking a serious question. Is VUG one of the most overlooked growth ETFs for long-term investors? Now, this is not a hype video. VUG is not magic. It is not risk-free, and it is not the same thing as owning the whole market. But for investors who want growth exposure without stock picking and without paying a high fee, VUG deserves attention. Because VUG is not the loudest growth ETF, but it may be one of the simplest. VUG is the Vanguard Growth ETF. It is a passive ETF that gives investors exposure to large-cap growth stocks. The fund seeks to track the CRSP US Large Cap Growth Index, and one of the most important details is the cost. VUG has an expense ratio of 0.03%. That is extremely low. For beginners, the simple explanation is this: VUG is designed for investors who want exposure to large U.S. companies with growth characteristics without trying to pick individual stocks. But investors also need to understand what VUG is not. It is not a total market ETF. It is not a value ETF. It is not a dividend ETF. And it is not a complete portfolio by itself for every investor. VUG is a growth ETF, not a complete U.S. stock market portfolio. And that raises an interesting question. If VUG is simple and cheap, why do so many investors overlook it? VUG can be overlooked because it is not as loud as other growth stories. QQQ gets a lot of attention. AI stocks get a lot of attention. Individual tech stocks get a lot of attention. The biggest winners in the market often dominate the conversation, and because of that, a simple growth ETF like VUG can feel almost boring. But boring is not always bad. Sometimes the market pays attention to the exciting story and forgets to check the simple tool. VUG does not need to be a trending stock. It does not need a dramatic story. It is a low-cost ETF that gives broad, large-cap growth exposure. That can be useful for investors who want growth but do not want to bet everything on one company or one theme. Sometimes the boring growth ETF is the one investors forget to check. But before deciding whether VUG is useful, we need to understand how it chooses growth stocks. VUG is not just a random basket of tech stocks. It follows a rules-based growth index. The CRSP growth methodology looks at different growth characteristics. That can include expected earnings growth, historical earnings growth, sales growth, investments relative to assets, and return on assets. In simple terms, the index is trying to identify large-cap companies with growth traits. This matters because VUG is not a fund manager personally choosing favorite tech stocks. It is not a hand-picked portfolio based on opinions. It is rules-based growth exposure. That can be attractive because it keeps the process simple and disciplined. But it also means investors need to understand the rules and accept the exposure those rules create. VUG is rules-based growth exposure, not a hand-picked tech portfolio. Now that we know how the ETF finds growth, let's look at what kind of exposure investors usually get inside VUG. Inside VUG, investors usually get large-cap growth exposure. That often means a strong tilt toward technology, but it can also include communication services, consumer discretionary companies, and other large businesses tied to innovation, scale, and growth. The important point is that VUG is broader than buying one or two individual stocks. You are not betting on only one company. You are not betting on only one earnings report. And you are not trying to guess the next single winner. But VUG is still growth heavy. That means its performance can be heavily influenced by large growth companies, market expectations, valuation, and investor sentiment. So VUG gives broad growth exposure, but it is still growth exposure. That is a trade-off. And this is where many investors naturally compare VUG with QQQ. VUG and QQQ are both popular with growth investors, but they are not the same ETF. QQQ tracks the NASDAQ 100. That gives investors exposure to 100 large non-financial companies listed on the NASDAQ. QQQ is famous. It has a strong brand. It gets a lot of trading attention, and many investors use it as their default growth ETF. VUG is different. VUG tracks a large cap growth index. It uses a broader growth screen. It has a very low expense ratio, and it is designed more like a simple long-term growth ETF. So VUG is not just a cheaper QQQ. It is a different growth tool. For some investors, QQQ may be the better fit. For others, VUG may provide a broader and lower-cost way to get large-cap growth exposure. But neither one should automatically replace a diversified core portfolio. That is why we need to compare VUG with VOO and VTI. VUG is a growth tilt. That is the key idea. VOO tracks the S&P 500. That gives investors broad, large-cap U.S. stock exposure. VTI is even broader because it covers the total U.S. stock market. VUG is different. It focuses on large-cap growth companies. That can be useful if an investor intentionally wants more growth exposure, but it also means VUG is not the same as owning the whole market. For many investors, VUG may work better as a satellite position. The core of the portfolio might still be built around broader ETFs like VOO, VTI, or retirement account funds. Then VUG can be used as an additional growth tilt. The mistake would be thinking VUG is automatically a complete portfolio by itself. VUG can complement a portfolio, but it is not the same as owning the whole market. Now, one reason VUG is attractive as a long-term tool is its cost. One of VUG's biggest advantages is cost. The expense ratio is 0.03%. That is extremely low. For long-term investors, low fees matter because fees create drag. A small annual fee difference may not feel important in 1 year, but over many years, lower fees can help more of the investor's return stay invested. This does not mean VUG will outperform. Low fees do not guarantee returns, and a cheap ETF can still lose money. But when you are buying index exposure, cost matters. The lower the fee, the lower the hurdle. That is especially important for buy and hold investors who plan to keep an ETF for many years. Low fees do not guarantee returns, but high fees make the hurdle higher. Still, low cost does not remove the biggest risk: growth concentration. The first major risk with VUG is growth concentration. VUG is diversified inside growth, but it is still a growth ETF. That means it can be heavily exposed to mega-cap growth companies, technology-heavy sectors, AI expectations, and high valuations. Growth stocks can perform very well when earnings expectations are strong and investors are willing to pay high multiples. But growth can also underperform for long periods. Sometimes value stocks lead. Sometimes interest rates pressure growth valuations. Sometimes the market becomes less willing to pay for future growth. So investors should not buy VUG only because growth has worked recently. That is performance chasing. A better approach is to ask whether growth exposure has a clear role in the portfolio. VUG is diversified inside growth, but it is still a growth ETF. And that brings us to the second risk: valuation and interest rates. Growth stocks depend heavily on expectations. Investors often pay higher valuations because they expect strong future earnings growth. That can work well when companies keep delivering. But if expectations become too high, even great companies can disappoint. Interest rates also matter. When rates are higher, future earnings can become less valuable in today's dollars. That can put pressure on growth stocks and growth ETFs. VUG can include very strong businesses, but strong businesses can still fall if valuations get stretched. That is one of the hardest lessons for growth investors. A great company is not automatically a great investment at any price. So investors need to watch earnings expectations, valuation, interest rates, AI optimism, and market sentiment. Growth stocks can be great businesses and still fall if expectations are too high. And there is one more portfolio risk many investors miss: overlap. Before adding VUG, investors should check portfolio overlap. Many people already own VUG-like exposure without realizing it. If you own VOO, you already own many large growth companies. If you own VTI, you also own them. If you own QQQ, you may already have even more growth-heavy exposure. If you have a 401k, target date fund, or another growth ETF, there may be overlap there too. The risk is not that overlap is always bad. The risk is accidental concentration. An investor may think they are diversifying by adding more ETFs, but sometimes they are just buying the same companies through different wrappers. So before adding VUG, ask 3 questions. What do I already own? How much growth exposure do I already have? And is VUG adding a role or just adding more of the same? Before adding VUG, make sure it adds a role, not just more of the same. And this is exactly why we analyze ETFs beyond the ticker. This is the kind of no-hype ETF breakdown we focus on at Boring Money Wins. Not chasing the loudest trend, not buying growth just because it went up, not ignoring fees, not ignoring concentration, and not adding ETFs without understanding portfolio overlap. The goal is simple investing education without hype, panic, or unnecessary complexity. If this kind of breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now that we understand what VUG is, why it is overlooked, and what risks matter, let's make this practical. Who may actually like VUG? VUG may appeal to long-term investors who want growth exposure. It may fit investors who like low-cost ETFs. It may fit people who want broad growth exposure without picking individual stocks. It may also work for investors who already have a diversified core and want an additional growth tilt. The key is that the investor should understand the volatility. Growth ETFs can perform very well, but they can also go through painful periods of underperformance. So VUG is not for someone who wants the smoothest possible ride. It is for someone who intentionally wants growth exposure and understands the trade-off. VUG may fit investors who want simple, low-cost growth exposure, but it should still have a clear job in the portfolio, and that means some investors should be careful. Some investors should be careful with VUG. If you want total market exposure, VUG is not the same as VTI. If you want broad, large-cap exposure without a specific growth tilt, VUG is not the same as VOO. If you already have too much growth exposure, adding VUG may increase concentration. And if you are buying only because growth stocks performed well recently, that is not a disciplined strategy. And if you need lower volatility, VUG may not be the best fit. The biggest mistake is thinking that low cost means low risk. VUG is low cost, but it is not low risk. It still carries growth concentration, valuation risk, style cycle risk, and volatility risk. So before buying VUG, the question should not be, is this ETF cheap? The question should be, what role does this ETF play in my portfolio? Now we can bring everything together. So, is VUG the growth ETF many investors are overlooking in 2026? Yes, it may be. VUG is simple. It is low cost. It gives broad, large-cap growth exposure. And it can be a useful tool for investors who want growth without picking individual stocks. But VUG is not a complete portfolio by itself. It is not the same as owning the whole market. It can overlap with other ETFs, and it still carries growth concentration and valuation risk. The balanced answer is this: VUG may be a strong option for long-term investors who want a low-cost growth tilt, but it should have a clear role in the portfolio. The best ETF is not the loudest one. It is the one that fits the job. That is the boring answer. And boring money usually wins because boring money usually survives.